And we're hoping this will be the start of a lot of these. Make it easier on our agents to get information about Hometown and the products we offer from the comfort of their own computer or office. So um, I'm going to turn it over to Evan. He has done renovation loans for over 10 years, close, probably over 11 years at this point. Is super knowledgeable and holds our hands, as the loan goes through. And I would venture to guess has not had a question that he could not answer or find the answer to. So Evan, I'll turn it over to you. I'm going to mute my mic and let you talk.
Yep. Thank you, Logan. I appreciate it. And welcome, everybody. I appreciate you taking time out of your busy day. This is the introduction to renovation lending, hometown lenders, hometown renovation, as we call it. So today I hope to kind of go over what these products are about, how to use them, what products we have, and hopefully give you some ideas to expand your business. So let's get into it. And the first thing I want to show you here is a great graph that's been passed around showing homes that are getting to that age where they are ripe for remodel, prime remodel years, meaning 20 years old to 39 years old. And as you can see here on the side of the graph, it's going to go up quite a bit in the next 3 to 4 years. And these are in the millions too. It's 21 to 24 million homes in that age range where there are prime for remodel. So you got to ask yourself, how many of these transactions do you want to be a part of? And a great way to get a piece of them is being at least a little bit knowledgeable about these products and trusting Hometown to help get these closed with you. So let's talk a little bit about that, right? So these loans are great to expand inventory and what you're showing your client, right? Maybe your client's approved for $200K purchase price, but they're just not finding anything available at that range that they like. So the idea here is maybe you show them some of the ones that are priced at 130K, but they need some work, right? So if it's priced at 130K and needs 40K in renovation, there's an opportunity there for renovation loans. Maybe the home is in right near the school, not too far from the job, great neighborhood, but the siding is a hideous lime green, or the kitchen's dated, or there's a damaged roof with mold issue. That's what these loans are for, to fix those issues. And it makes a world of difference if you can help your buyers see homes for what they could be rather than what they are today, right? Help explain what these loans can do, show them more opportunities, more homes that fit in their range by using these renovation loans. Expand what you're showing them. Same thing with sellers, right? No seller wants to ask their clients to cut a 10K check on a roof repair or 15, 20K to remodel the kitchen to make the home more marketable. So why not let the buyer decide what updates to make when they buy the home by marketing as a renovation potential with hometown lenders. So that's what these loans can do. They can allow you to show a wider range of inventory to your buyers, expand what you're showing as a seller with renovation lending. So give a quick rundown of how we can do that here. At Hometown, we offer 5 different renovation products: FHA 203K, Fannie Mae Home Style, Freddie Choice, USDA, and VA renovation products. And I'll get into it a little bit later, how we've made these very simple and streamlined to where they mirror each other. All of them are almost exactly the same, except VA renovation is a little bit different. And I'll get into that a little bit later. Common question that we get asked is about the credit guidelines. How different are these credit guidelines? What do we need to know? Well, it's really easy. They are 99% the exact same credit guidelines as the traditional loan counterpart, right? If you're dealing with an FHA 203K, loan to value and down payment is still 96.5%. Conventional loans are still 95%. 100% for VA and USDA renovation. You're gonna, what are the rules for a non-occupying owner? Same as they would be for FHA. They are essentially the same credit guidelines. DTI is the same. DU approval, it's all the same setup. There are a few small overlays. For example, 620 credit score is the minimum, but really that's the main credit overlay that we have. Everything else, you're running off those base credit guidelines. So there's not much new to learn. You already know most of the credit guidelines. You know these loan to values we need. But the great thing and what makes these loans possible is when we get that appraisal, we're not getting the value of what the home is, right? Because we have to fit in the money for the renovation. If you're buying a 100K house and putting 40K in renovation, well, the home as is would typically need to appraise for about 100K, right? That's what you're looking for. That same as the purchase price, that acquisition cost. But with these renovation loans, we are going to get the future after improved value or subject to value, because it's subject to the renovations we're doing. Your buyer is going to put together a bid for the work that they're doing, whether it's a remodel or some mandatory repairs. I'll get into that a little bit in a moment, but we are going to send that bid to the appraiser, and they're going to pretend it's already got a remodeled kitchen. It already has new flooring, new windows, the roof leak is fixed, and they're going to appraise the home as if those things are done. So that higher value is what makes these loans possible. And that's the same with the loan to value, right? It's based on that after improved value, because we're sending that bid for the work that they're doing. So the comps are all going to match that remodeled kitchen. They're going to find comps with the new siding. That's what makes these loans possible. And actually, FHA goes one step further and gives us 110% of that after improved value. So that's always a little confusing for people. So to give an example, if you had a purchase price of 100K, we want the value to come in at least 100K. Anything less, the borrower would have to bring in extra funds to make the loan to value right, or the seller would have to reduce the purchase price, which is always a tough thing to ask. So, for that same example, if it came in at 95K, they'd have to bring in that 5K difference above closing costs, above down payment. Same thing with renovation loans. We want that future after improved value to be at least the purchase price plus renovation. So if it, using easy numbers, of course, but if it was a 60K purchase price with 40K in renovation, what do we want the value to be? We want it to be 100K, just like that 100K purchase price. It's the purchase price plus renovations. Let's say on this FHA 203K, it comes in at 95K, which is 5K short. Well, 110% of that 95K, I had to write this down, is actually 104,500. So we are overvalue with that 110%. The homeowner does not need to bring in any additional funds. We don't have to have that difficult conversation about lowering the purchase price. We can proceed with the minimum investment just like we could on a loan that appraised for enough value. And that 110% is stretched even further the larger the loan, right? A 200K value is 220 for an FHA 203K. So these loans allow you to take uninhabitable and outdated homes to life. And I'll get into a little bit more about that here in a moment. And I know there might be some questions about some of this. We will have some time for some question and answer at the end. But quick, just what you need to know, some common questions that we get asked. The repairs take place after closing. That one comes up all the time. Do we have to wait for the repairs to be done? Absolutely not. We get that bid, we order the appraisal, we get the appraisal. As long as the value's there, we move towards closing. The seller is paid at closing, just like they would with a normal transaction. The homeowner is the owner. They have the keys to the home. Then the work begins. It's very similar to a traditional loan, once we get to the closing table. They get the keys, work begins. These loans allow a couple types of repairs, and I'll get into the specifics of what those repairs are here in a moment. But an overview is they allow mandatory repairs that affect habitability. Maybe that roof is leaky and something the appraiser would call out as an issue. Mold damage, broken windows, damaged siding, all things that would be an issue on an appraisal, to where the seller would either have to repair them before closing, or your only other option would be paying cash for the property. With these loans, we can provide a bid to repair those items and proceed to closing, because we're essentially making a promise to do them after closing. So we can do any mandatory repair that would be required on an appraisal. And you can also do desired repairs or a combination of both. Maybe you're fixing that leaky roof with the mold damage, but you also want to do a kitchen remodel. That's the most common thing I see with desired repairs, are those kitchen remodels. So you can do a little bit of both, or one or the other. There doesn't have to be any mandatory repairs either. It can just be a dated property that is in need of upgrade. So it's a great selling point to be able to not only get them in that house that has an issue, but to throw in some desired repairs so they can really customize that home the way they want it. The purchase contract is another common question we get from agents. It's a standard purchase contract. It's still going to have the actual purchase price, all your normal documents. It is just a standard purchase contract. The one thing that is a little different, the financing that is listed, just like it would list FHA or conventional, it's going to say FHA 203K or conventional home style. Otherwise, standard purchase contract. Unfortunately, on these, we cannot do DPAs, down payment assistance. They do not mesh well with these renovation loans and some of the requirements and what the DPAs would require. So no DPAs, wanted to make sure we mention that. These are split into limited and standard versions for these products, all of them except VA. I touched on that earlier. We've kept it real simple by keeping these products the same when it comes to the renovation part, right? So you got your credit guidelines. They're either going to go FHA, conventional, USDA, and then the renovations are going to be the exact same setup. So it streamlines it for you, for the homeowners, and it's easy to understand. So we'll get into a little bit of that here on what the allowable repairs are. Honestly, guys, people always ask me, what repairs can we do? It's easier to say what we can't do than what we can, because we can do just about anything that is a normal house type item, right? If it's something that's normally done in a house, we can certainly repair it or add it, or even upgrade it. So let's get into the limited program repairs, and this is for cosmetic repairs only. So the limited program allows cosmetic repairs that are not structural, and there is a cap on this limited program. It goes up to $35K in total renovation. So that includes, windows, mold remediation, fixing the roof. A lot of times people think roof repairs are structural. They're not, unless a tree fell on the roof or something like that. Otherwise, it's primarily a cosmetic repair. Siding, pool repairs. I see that a lot, where there's pool issues that are called out by an appraisal, and we end up getting that switched over to a renovation loan. Outdated electrical wiring, plumbing, HVAC, any cosmetic type fix can be included in this limited program, up to $35K in total renovation, as long as it is permanently affixed. That's a good way to describe what can't be done, right? You can't do blinds on a window, because you can take the blinds with you when you leave. But if it's permanently affixed in a regular type house item, it can be included in the limited program. One exception to that affixed rule would be appliances. You can do a new appliance package, top to bottom, fridge, microwave, dishwasher, oven, all those things can be rolled into this loan, and they do not have to be permanently affixed. In fact, FHA actually allows washer and dryer as well. I've seen a couple of those recently to where they had some room in the value, threw in a new washer and dryer. But all the programs allow kitchen appliances to be updated. So again, this is the limited program, and that there is a cap on those repairs at 35K. And when you're talking about the limited program, all you need is your contractor, which I'll get into that in a moment, and the bid for the work to be done. Pretty simple stuff. I'm switching over to the standard program, and we can of course do everything I mentioned in the limited program, all those cosmetic, non-structural repairs. But with the standard program, we can do major rehab, structural repairs, additions, and there is no cap on the amount. I closed a 350K project just last week. The only cap to the repairs is a cap on our loan amount, right? It's loan to value based on that future appraised value that I mentioned, but there is no cap on repairs otherwise. So foundation issues, major additions, two-story additions. I know a lot of you are in Alabama. I've seen some that had additions that were added unpermitted that needed to be fixed. That can be done without issue. So everything that a limited program offers, but standard you can do structural changes as well, major structural additions. You can even do new pool installations with home style if needed. The one big change with this program is there is an additional requirement, and that is a HUD consultant, and that is true on our FHA, conventional, and USDA renovation products. They all again follow this limited and standard setup, keeping it easy, right? Easy to remember. Non-structural, under 35K, just the contractor, just the bid, easy stuff. Structural, no cap on repairs, HUD consultant is required. Sometimes I hear some fear with using that HUD consultant. So let's talk about a little bit about their role, because they really are helpful and can help set us up for success. Again, required for the standard renovation program. That HUD consultant is going to go out as soon as we're under contract. A lot of times we're already going to know, this house is going to need a little bit more than 35K, right? Sometimes we see them with just one or two easy issues, a couple desired repairs. Sometimes we know that home is going to need a lot of work, and that's where we want to get that consultant out right away. These consultants are home inspectors, and they will go out and provide something very, very similar to a home inspection. The difference is they're also going to provide a list of mandatory repairs. That way the homeowner can take that list, go to a contractor and say, this is what I must do, and then add on any desired repairs as well. So that's where this consultant can be a great tool to use in determining those repairs up front. The downside with the limited program is we're kind of relying on the homeowner to figure out what those repairs are, if there are mandatory items, on their own, right? Maybe they get A, B, and C on the bid. We order the appraisal. The appraiser might come back and say, well, you got to fix the broken window too. So we'll have to go back and add that. But with these HUD consultants, we can proceed with confidence that we know we already have all the FHA required repairs, all the repairs that might be required with a conventional appraisal, and it really sets us up for success and a smooth transaction, especially on these heavily distressed properties. So there's a lot of guidance that consultant does. And the consultant comes back into play by performing draw inspections after we close. So they are kind of signed on for the project as well after closing, and can be a great resource during the project for the homeowner. Once the bid is ready, after that initial inspection, they'll review the bid to confirm that it does have all those mandatory repairs, provide us with a report, And that's really what we'll use to proceed with the appraisal instead of just the bid as we normally would with the limited program. I'll talk a little bit about the consultant fee structure on the next slide, but the good thing about the consultant fee is we can reimburse the homeowner at closing for whatever they paid that consultant via a credit to their closing costs. So they do have to come out of pocket the day of inspection, just like a home inspection, but the difference is we can reimburse them for that fee at closing when they close, take some of that money off the closing costs, which is a great thing. The consultant fee structure is based off of how much the bid is. So, you know, I'm imagining that your home inspections are probably somewhere in that $250, $350, $400 range. Similar situation with the consultant. They get paid that $400 the day of inspection. And then if the borrower moves forward, they provide the bid, and then before the consultant will release that final report, they would have to pay the remainder due based on how much the bid is. But that 400 is credited to them and kind of comes off that balance. So if it ends up being a 50 to 70K bid, they would have paid that 400 up front, and then it would be another 400 for the total fee of $800 for their inspection and report and signing them on for the project. So having that base knowledge of what those consultants cost can help. These consultants also are a great resource for contractors in the area as well. So I'm a big fan of using these consultants because I've seen time and time again, they help set us up for success as the loan proceeds. So real quick, I'll be quick on the VA, but unlike our four other programs that follow that limited standard setup, VA renovation is something we were super excited to roll out recently, but it does not have that limited standard setup. It is essentially an extended limited. There's never a consultant involved, but the max renovation is more than the 35K. It's actually 50K. So they can go up to a higher amount, but there can never be a structural repair with the VA renovation. It is only for cosmetic repairs. So you can essentially glue that limited repair list to this program, except we can go to a higher amount. No consultant, no structural repairs. The only difference is the contractor must register with VA, but don't worry, we've done that process and we can help them do that. It's fairly simple. It's a few extra forms to fill out, and then we send the paperwork to the VA. And oftentimes contractors are happy to get on that list for future VA business. And it's a great way to help out veterans get into homes that might be distressed and need a little love. Biggest difference with these also is they have to be done in 120 days, whereas FHA allows you 6 months to complete the project after closing. Conventional, you actually have up to a year to complete the project after closing. Contractor validation, guys, and I'll tell you, this is the one thing that helps these move quickly. And I will touch on closing timeline here in a couple slides because I know that's a big deal. And having these contractors helps us make those closing lines easy by a long shot. And here at Hometown, we do have some contractors that we've worked with in the past. We can't recommend them, but we can supply names of contractors we've worked with previously, and that can drastically streamline the process, having those names and resources for homeowners to go through. But we do take care of that contractor validation, which is a fancy way of saying contractor approval. We take care of all that paperwork we need from them. We explain the process and try to make it as easy on them as possible because they are valuable to the process. What we require is very basic also. It's what the state requires, right? We need the state license. In Alabama, they're required to have an Alabama home builder's license for any project over 10,000. In any other state, we require no more than what the local municipality or state requires, no more, no less. General liability insurance of at least $1 million. That is an industry standard. It's very unoften I see even people that aren't licensed not carrying at least that much insurance. And it's a bit of a red flag when they don't. So state license or local municipality, general liability insurance, and then they must accept the payment terms. And I'll touch on that in a moment, but they vary based on the limited or standard program. But that's something that, once we get into these loans, our department can reach out to that contractor, explain what those payment terms are, and make sure they're comfortable with it before we get too much further, as well as confirm their license and insured like we need. And we send a quick paperwork package via DocuSign. Our goal with the way we designed it, again, to make it easy on these guys so they want to do these loans with us, and we're able to get to closing as soon as possible, because that's all of our goal, is to get to closing. No HUD certification required. I hear that question often. It's hard to find a HUD certified or FHA 203K certified contractor. There's really no such thing. Yeah, some people might use it as a marketing gimmick, and that's great idea, but we don't require that. HUD doesn't really approve contractors. We just need these basic requirements and a willingness to be part of the program. And then I mentioned it on the last slide that VA does take it a little bit further. They have to register with the VA, and we can help them do that when the time comes. As far as the review process, that's a very quick turn time, 24 hours, 90% of the time it's the same day we receive it, just making sure they're licensed, insured, accepting of the payment terms, and completed that basic document package that we send them via DocuSign. Closing timeline. So I know this is a big one. I've heard everything. I think just yesterday I heard someone mention their fear was it takes 6 months to get the closing. Absolutely not. On a purchase, we always ask for 45 days. On a contract, it can take less, it can take more, but it's dependent on when we order the appraisal. We're typically about 21 days from closing when that appraisal is ordered. So, when can we order the appraisal? We can order it once we have the final bid from the contractor and those basic documents I mentioned. So, we knocked one of these out in 30 days last month because the homeowner was able to get us that bid and get us that contractor within the first week. So we got that appraisal ordered within 7 days and got it done in 30. Now, not everybody's going to be able to pull that together in 7 days. It depends on the project, depends on how quickly they can find that contractor. But 45 days for closing is a good out of the gate estimate of how long it can take. Of course, if they're doing a 150K project, that might take a little bit longer to pull that bid together, but it doesn't always have to either. It's just about when we have those items for the appraisal, because the appraiser, again, needs them because he's assessing value on the work we're doing. He's whatever mandatory repair or whatever's wrong with the home, he's going to pretend it's fixed when he gives us that appraisal, so there won't be any appraisal conditions or roof inspections required, because we already have the work and are promising that we're going to do it after closing. Of course, if we're using that standard program, we do need that consultant inspection to be completed prior to the appraisal order, because that contractor needs that list from the consultant to put together a bid with all the repairs needed. So all those things need to be done. Again, 21 days from closing, from the time we order the appraisal. So as long as we're all on the same page and communicate with timeline and what we need, I've definitely found in my career these go smooth, right? It's sometimes these loans can have a bad name because they weren't accurately explained what we need and the timeline and what it's going to be like. And that's not how we work at Hometown. The first thing we do is we get on the phone, we explain to the borrower, realtors, and make sure everybody's aware of what we'll need to get where we're going, and we're kind of all in it together to get there. So again, 21 days from closing, a good purchase price. Closing time frame is 45 days, just because that's a general estimate, right? 1 to 2 weeks to pull that bid together, and then we have a little bit of breathing room on that 21 days from closing, leaving us with about 30 to get there. Project Toolbox, and I'm making good time, going a little bit quicker than I thought. So just a few notes. All of our, whatever our bid comes in at, we're going to add an extra 10% to that bid, and that's there for anything unforeseen, guys. I'm sure you guys have seen some of these homes where there might be plumbing issues. So if the contractor has 5K on the bid for plumbing, we're going to have some extra padding there. So when they get into that wall and it's a little bit worse than we thought, there is that 10% additional funds there as padding to make sure that homeowner is taken care of, and they have those funds to dip into for any issues that come up. And that 10% actually becomes 15 when the utilities are not on and functioning. But that leads me, another great thing about these loans is the utilities don't have to be on for us to proceed. So whether or not maybe something's wrong with the electric and that's why we're not going to turn it on, or maybe it's a HUD home where it's extremely difficult to get them on, or they're just not willing, we can close these loans without the utilities being on and functioning. The only difference is slightly higher contingency. And then we ask the contractor to do a visual inspection and make a note on the bid that, they didn't see any issues, or whatever issue they saw has been included on the bid. But we have that little bit of extra there, just in case there is something wrong once we turn them on, a little bit higher contingency for the contractor to fix whatever comes up. And if that money's not used, it's applied to the principal of the mortgage and reduces the principal. Change orders are submitted throughout the project to access those funds. So, the contractor writes it up. Turns out there's more plumbing issues than we thought. They submit to us. We approve the change order and give them access to those additional funds. As far as payment terms go, because that matters to these contractors. I know some of you might have contractors you work with. That's great. We'd be happy to speak with them in advance of doing these deals and help them understand what this program is all about and how they're paid. So the one that everybody prefers is that 203K limited, because they get 50% of the project up front and then 50% when the project's complete. So that's one they always prefer. The other programs, it's paid based on a draw schedule. So they complete 20% of the work, they get reimbursed for 20% of the work. They complete 15 or 20 or whatever the percentage is, they get reimbursed. And that's where that consultant comes into play after closing, is by doing those draw inspections to release those funds when the time comes. We can do some upfront money on those standard programs. Conventional allows 50% of the material cost, or 20K, whichever's less. And then the standard renovation programs, you actually have to submit some invoices, and that allows us to release 50% of those invoices up front. So there is some upfront money on those standard programs, but primarily the contractor is paid via draw inspections from the contractor. And the contractor, that won't be all of their favorites. Some of them it's business as usual. Some of them it's important that we make sure they understand that, and it might not be for them, but again, there is some upfront money, and that's most times okay with these guys. Especially right now, I've noticed they're more open as the market changes, right? To the more willing they are to work, the more willing they are to accept payment terms. And then VA allows 2 draws during the project with no funds up front. And then finally, the great thing about Hometown is we have renovation specialists. I'm here to answer questions, realtors, borrowers. Logan and his team are extremely knowledgeable as well. But renovation related questions, I'm there to walk your borrower through the process. And we have a team of specialists that are essentially on call for just about anything that comes up, from homeowner to contractor to realtor to listing agent to consultant. We are here to answer those questions and guide them through the process. And that's something that not many mortgage companies offer, but we do offer it here at Hometown, as well as those 5 renovation products. So lots of options, lots of help, lots of experience. And then, of course, Logan, Christy, and their team are just great at doing what they do, and they're still heavily involved in that process, taking care of your borrower from a loan aspect, and we're kind of all working on it together, getting these to closing as soon as we can. So, guys, that is all I had for today. Just reach out and apply, and hopefully we get some deals here soon. And I think we'll open it up to some Q&A, unless Logan or Christy had anything to add.
I do not. I really appreciate that. I think that was awesome. Thank you. Let's see, Q&A. How do we do that? Do we just
I think
ask
we
a
have
question?
a chat. We can drop questions, or we can unmute everybody and see how that goes.
Joy has a question. Yeah, let's just unmute everybody and everybody can ask a question if they need to.
Joy, I unmuted you. You might need to unmute yourself now.
The mic button should be up towards the top, Joy. That's what you're looking for.
And if that doesn't work, there's a Q&A chat if you wanted to type it as well. Hey, Joy. Yes. So VA is the one that's extremely strict. It has to be done in 120 days. That's it. But in truth, with FHA, once 6 months, conventional once a year, these things go over all the time. There's weather issues, lots of things that might come up. Extensions are absolutely allowed and happen quite often. Ultimately, we just want to get the project done.
Evan, is there a fee for the extensions or anything like that?
Nope, there's no
Okay.
fee.
Okay. I didn't think so, but
Actually, we got another question coming. It is only one closing, right?
Yep, one closing, one rate. So much of it is like a traditional loan. I mean, their payments due 1 month from the end of the month, like it usually is. One rate, one closing, just like a regular loan. It's a regular mortgage after we close. That reminds me of one other neat thing about these loans is when we have these huge projects, they can actually roll in mortgage payments as well, up to 6 months. So, if the home is really rough and they can't live in it,
if the
they can-
value's there, right?
if the value's there, yes, the value
after
does
it's
need to be there.
completed. Yeah.
So they can finance those payments and still have money to live where they're living while their home is renovating.
Yeah, for the most part, they are. They may be a little bit worse, but as long as their credit is, fits the criteria and is, pretty good, then the rate's not gonna be that much different. Anybody else have questions? Good. Okay. Well, thank you, Evan. We will share this with everybody. We hope y'all have a great day, great afternoon.
Thanks, guys.
Thanks,
All right, see
everyone.
y'all. Bye.